Though managed to eke out a 2.8% gain there. Let's bring in Drew Nordlicht right now. He is managing director, also partner at HighTower San Diego. Assets under management, AUM $711 million with the M at last count live out of San Diego. Drew, good to see you and appreciate your time. So a bit of a pullback, and we're waiting on what the Fed has to say at the end of the two-day meeting. You know, the odds have been slipping further and further down for an October hike, but pricing in more now. December, is that when you see them pulling the trigger?
Yes, Martin. Well, thanks for having us. We do think that December will be the time frame by which the Fed looks at a rate hike. The issue they're faced with right now is they have this never-ending cycle of, do they raise rates and impact financial markets? And the concern is that we begin to see a downdraft as you get revaluation on risk assets. And then does that have a negative feedback loop to the economy? Alternatively, is the economy strong enough to handle the rate hikes? And the other piece of it is that the economy has also gotten addicted to the sugar that they've been adding for the last 6 years by zero interest rates and also QE. So we've had this performance in asset prices as well as the economy is built up really by what the Fed has done, and now they're looking at removing it. So we have this, you know, 1980s round and round cycle by which they're looking to try to break that by raising rates. Yeah. And the question is can they do that without a negative impact on the financial markets?
Indeed, that is probably the $64,000 question, Drew. So take a look back with me, if you could, over the last, say, 4 weeks, 5 weeks or so. You know, from August, we had that big correction. Now we've come back. It's pretty clearly risk on. How much of that is the weak data reinforcing expectations the Fed is going to hold off, maybe only pull the trigger in December? Some people are still thinking it's not going to be until 2016. And how much of it is because earnings, even though the bar has been lowered several times, right, and it's not exactly hard to jump over lowered expectations like that, they've actually done a little bit better than expected, especially in the tech space.
Right, Martin. I mean, you're exactly right. So we've had this significant bounce since the September, you know, the end of last week of September lows, right back into the range we were trading in for the first 8 months of the year. So now what's happening? Well, people are paying 19 times earnings for this year and 17 times forward-looking earnings. So they're being forced back into that same methodology we had for the first 8 months and for the last 6 years, which is the Fed's in the marketplace. How much more will we pay for a stream of earnings? And the feeling is that it's okay to pay more because the Fed is there. That's the dynamic that might change come a Fed rate hike. Specifically to technology, you have an economy there that is a subset, very unique in nature, where you're getting a significant spend on security, a significant spend on productivity enhancement. So those are the areas that corporate America is willing to spend on, so you still have a consistency of earnings. And those are the areas that the consumer is willing to spend on, is improving their lifestyle, more access to information, faster streaming of information, the disconnecting of the cable like we're hearing about. So technology has got an underlying fundamental basis that makes it slightly different from the remaining sectors of the S&P.
Okay, fair enough. That's tech. In the old economy, though, the industrials, et cetera, right? The classic cyclicals. What I'm still not seeing, and I think people are still holding out and waiting, right? The CapEx cycle. When is that going to kick in? When are they going to kick in?
So right now, Martin, that's a classic value trap where you have the sectors continuing to decline. You have numbers reaching new lows every single time. The lowered expectation earnings that they had going into this quarter are actually being lowered going forward. The materials, the energy sector are the sectors where you're still getting revisions downward, unlike some others where you already had lower estimates that are actually being beaten. So right now we view that sector or those sectors as falling knives not to be bought yet. You haven't seen a couple of quarters where you've got that rounding of a bottom. We don't think oil has hit a low yet. You had nat gas reaching new lows again today. So underlying those sectors, you have an underpinning aspect of decline that we don't think is going to stop anytime near term.
All right, so you like techs, we know that. You like consumer cyclicals. Healthcare as well?
Yeah, we do like healthcare. So interestingly enough, I know there's a lot of significant news in the space related to politics and drug pricing, but we're looking for sectors that actually have earnings growth. So, and I'll define that as something that's different from EPS growth. So earnings per share growth can actually be manufactured by reducing share count. And a lot of companies have done that in the present environment, where they're not actually growing earnings, they're just reducing the divisor, the share count, and therefore it looks like they've got a higher EPS. So the medical sector, specifically healthcare, some of the drug companies, some of the medical device companies, have shown that their ability to actually grow true earnings, the actual dollar amount that they earn at the company balance sheet level. And as long as those fundamentals remain in place, we're buyers of that space. The technology space falls in the same category, and the consumer cyclicals fall in that category. So avoiding sectors that have manufactured EPS numbers by reducing share counts in the marketplace.
All right, Drew, listen, you know, I don't mean to throw a curveball at you, but this is something that we are watching and also thinking about. I mean, in the gaming space, right, you've got Wynn, you've got MGM, you've got Sands, et cetera. We're looking at a property, a new one that's opening in Macau that's run by the Melco guys. Those are down, that's down in Australia. And, you know, it's much more mass market. I'm wondering, you know, you've probably seen the revenue numbers. They've been falling by the month over the past year or so, or year to date. These are tough times to be opening a new property in. Do you have a view on what's going on over there?
So while we're not experts in what's going on specifically over in Macau, I would say that anytime you have a circumstance where the outlying economy is showing signs of strain, that gaming is a very much discretionary circumstance. And so as individuals, consumers, even the higher end feel pressures, they begin to retract their spending habits. And one of the first things you see, and we saw this domestically here in 2009, is gaming is a severe luxury. It's an entertainment. And it's an entertainment that can cost significant money during any period of time, between lodging, travel, and then the time spent at tables for that high entertainment. So we would say look for areas where there might be strain economically. So China's numbers obviously have been a source of concern as of late. So we wouldn't be buying into the gaming space and specifically opening up new properties at a point where economic circumstances against you.
Okay, noted. Excellent, Drew. Listen, great to talk to you. Thanks for the value. Do it again soon. We've been talking to, yeah.
Thanks,
Drew.
Martin.
Okay, quick break on street signs. Take a look at our mystery chart for this Tuesday.